So I'm titling this "The Storm is Upon Us," kind of a QAnon phrase. It says that things that have been accumulating are now starting. We've been talking about the fact that we are going to be entering into a very, very dark and scary time. It's coming upon us. It's here, and it's just starting. And there's no stopping it. We're just going to have to go through. This will be the fourth time I've gone through. So let's just go through this and let's just talk about our position. Now, my position, I represent investors. That's what most of my business is. I have a huge portfolio myself. I understand investors. We only have two goals. One is to make money. The other one is not to lose money. So timing becomes very, very important to us. I have a timing model that has been very, very accurate. I've been working on this for a number of years. It's pretty simple to do. It just takes a while to get used to it. It's an 18 and a half year real estate cycle. Lots of them around. You can check out. This happens to be mine. Works really, really well. Now I'm going to tell you that I represent money, and I want to make sure that my investors do very, very well. So we quit buying properties in 2022, March of 22. No more new mortgages, no more new capital. Now that didn't exclude the fact that we wanted to do some 1031 exchanges, because that's also part of our theme. My theme is the fact that we're going to be looking at endangered cities with terrible demographics, terrible governance, terrible futures to them, people leaving, which is really what we're talking about with demographics. And these are places that you need to start thinking, this is where I have my investments. What's it going to look like in 4 or 5 years? Because if you don't sell now, we're advocating that if you have a property that you need to sell, you should do it absolutely right now. Right now. I've told this before, but this is going to be your last chance. So if you don't get this sold now, we're going to be going into the waterfall phase, and you're going to be chasing it downwards. So this is the possibility of it. So while I have you, if you like our videos, please subscribe and give me a thumbs up. We're not going to chase you. We're not going to send you anything. It just helps our visibility on YouTube, and YouTube algorithms love this. Now, I've had a couple of really good guests, and last week we had Charles Hugh Smith. Brilliant man, just brilliant. We talked about his regression and bubble work that he's done. So we're going to go over that. But I do want to make some points clear, is that my business is strictly fiduciary for people who are investing, and we are very, very serious about this. So I get paid commissions to sell homes. We quit selling homes because it wasn't a good deal for our investors, and that's what we're interested in, because if we don't buy now, we will buy later on. And we are putting together pools of capital right now, and I'm going to show you why. So let me go to my first slide here. We're talking about a terrible storm coming. We've been talking about it. It is upon us. Now it is going to get worse. You see that tornado? It's coming right at us. It could be a huge Cat 5 hurricane. And when Charles Hugh Smith and I were talking about, we'll take a look at his charts as well. So what triggered myself, it was a timing model was saying the event was coming, where they was going to look at the end of the explosive phase. So when we look at our timing models, we have the accumulation phase and the explosive phase, which are most evident. We're just coming through them. In March of 2022, I saw the end of the explosive phase. That is, when you look at this chart, you can see the fact that in March of 2022, the Federal Reserve announced that they were no longer going to add liquidity. They were actually going to drain liquidity. They were talking about $100 billion a month, or over $1 trillion a year. And of course, my business is liquidity driven. Your business is liquidity driven. The economy is liquidity driven. When you start taking liquidity out of the economy, everything starts to falter. And when that happened, we quit buying properties. We quit putting 40 to 50% down. We saw some great properties, but when liquidity is removed, it was the end of the explosive phase, and it was the beginning of the cycle completion process, which is a process. It takes about 1.5 years to do. I recognize that. Had we purchased properties in 20 and 22, we had some magnificent properties come our way, but they're all would have been we would pay more money than what they're worth today. And that is not what we're here to do, because liquidity was being withdrawn. Let me go to the next slide. You can really take a look at this. Now, we have a historic loss of liquidity. I mean, historic, like as in it's never happened before. That's when we say historic, it's never happened before. We're talking about M2, which is all your savings accounts, your checking accounts, the CDs, is leaving the banks, and it's going into investment firms like Schwab and Vanguard and Fidelity. A lot of this is going into short-term treasuries, which you can understand. You can get a 2-year note over 5%, fairly risk-free, and of course, it's taking liquidity out of the banks. Let me go to my next slide. So you can clearly see the liquidity bubble that happened started in 2020. It just exploded. This is where we had that huge accumulation and the explosive phase because of this liquidity. You can just see it. Now, when money starts coming out, that's when the banks go into jeopardy. Just as us as investors, we quit purchasing. Banks don't have that luxury. They're invested for long term, and they cannot change their investment. Now, what's happening to them is that all through this bubble, they had all this extra money they were putting out at 3.5%, some at 2.5% long-term money, mortgages, 30-year mortgages at 3.5%. And just like a bond at 3.5%, when the bonds are now at 5%, that means a 3.5 is nowhere near worth of 5%. It's worth less money. You've lost money on it. All the banks that did those mortgages, if they're holding those mortgages, the value of that portfolio has declined. So they actually lost money on their portfolio. Also, they're seeing that M2 reserves and cash is leaving their banks. Remember, this cash that is leaving their banks has to be replaced. So they don't have cash sitting in their vaults. They have assets sitting in their vaults. They have loans sitting on the books. And when someone comes in and takes their $100,000 or $200,000 and they turn it into a money market at one of the major investment houses, they have to go to get this money somewhere. And they typically go to the Federal Reserve and borrow money, which they have to pay back. This is very bad for the banks. And now we're starting to see major defaults in a lot of the smaller banks, which do regional projects. But if you purchased a property in, say, 2018, 2019, 2020, and you put leverage on it, most of the commercial projects, when you buy a office tower, like 20, 30, 40 stories, you don't pay cash for that. You put 20, 30% down and finance the rest. If you did that on any of these, and often what happens is you get hotels that do that, you get bank towers that do that, office towers, you get multifamily that has done that. Now they come up for refinance. What has happened? Well, the value of the property has declined, and the mortgage is now double, maybe triple from what they had. So it's no longer an economically viable investment. In order to maintain the property, the investors have to put another 30% down on a losing proposition, and they walk away from the property. This impacts the banks. So you can see on this chart right there, you see the straight line. Now my cursor won't show on our video, but you can see that straight line. That was 1 week in March where the Federal Reserve injected $354 billion. That's billion with a B, into the economy and saved the banks. And of course, it was too late for Silicon Valley Bank, Republic Bank, Signature Bank, and Credit Suisse, but did stabilize the industry. But again, you can see the direction of that arrow. The liquidity, again, is being drained. This is very, very bad for the banks. And of course, it's bad for my business because the banks don't want to lend any money. They're keeping whatever cash they have, whatever liquidity they have, they're keeping it in their vaults. They don't want to give it to anybody because they may need it as reserves, and they're at risk. So if you have a good project, it'll probably get done somewhere. But if it isn't like the very best, not going to happen. This slows the entire economy down. And there's a ripple effect all through the economy. It takes a while for this to happen, and it's happening right now, and it is inevitable. So as you know what, as projects get stopped, that means the people working that project lose their jobs. They have to go somewhere else. And of course, that what happens is you get more labor. That's how you get unemployment. Let me go to my next slide and let's just talk about this. So here we are. When you see these inversions, this is a precursor to a terrible recession. The worse it inverts, the worse the recession. Our inversion is so bad, you have to go all the way back to Paul Volcker in the 80s when we had that terrible double recession. And that was because interest rates went up to 21%. It was just terrible. I lived through that. It was just terrible. We have not had anything since then. That means anyone who's younger than me has not seen this. It means all the middle managers and even some of the upper management have not been through a terrible, terrible recession like what is coming. They have no experience. They don't know what to do. But I'm going to tell you, it is coming. Let me go to my next slide here and let's just take a look at that. Now, typically, when you have an inversion, what happens is, where the short end is higher than the long end, so it's inverted. So the 2-year note is at 5 1/4, and the 10 is at 4 3/4. And typically, what happens is that front end, the 2-year note comes down to 3, and it uninverts, and the yield steepens. But what's happening now is that it is steepening, but it's because the long end is going up. So now today's the 3rd of October, we had a 10-year note almost at 4.8%. And we've got a very, very strong U.S. dollar at over 107 on the DXY. That's really strong. When the U.S. dollar gets strong, it just means there's turmoil all across the world. A strong dollar is not good for the world economy. But what's happening is that we're uninverting the yield curve by getting higher interest rates on the long end. That's not what's supposed to happen. Now, it's probably going to stop, but if it doesn't, we're getting the worst of both worlds. It means high short-term rates and high long-term rates spells real trouble for us. So hopefully that isn't what's happening, but it's heading that way. It is uninverting on kind of the wrong way. So here's the inversion narrowing as the 10-year goes up. Now, it's pretty evident when you look at these long charts how that's happening, and we're only about 0.5 point away. That can happen pretty quick because we gained like 20 hundredths in 2/10 in 2 days. So 5 days, and you've got a full point already, and that would uninvert. We could do this like in 5 days. That would be pretty doggone amazing. Now, I just had Charles Hugh Smith on last week, and I highly recommend that you listen to that video because he's a brilliant, brilliant man. He has the ability to take a complex situation and convert it to making it very easy and simple to understand. Now, his work is talking about when you do bubble studies, that the bubbles always retrace back to the beginning. So the bubble goes away. Economies don't like bubbles, and bubbles always burst. And this is talking about what happens when it bursts. So let me go to my next slide. This is very, very similar to mine. You can see on his slide, let me go to the next slide. You can see the 2 mid-cycle corrections. You can easily see the accumulation phase. There's the explosive phase. And what I don't show in my stylized version, which is right here, you don't see this, is there are actually 2 peaks. There's always 2 peaks to these things. The first peak came in March, April of 2022, like the end of the first quarter of 2022, beginning of first quarter of 2022. That was first peak. That's evident that is in. We saw that the textbook perfect would have come down about 11.5%. It bottoms, and then it forms the second peak by coming up 5 or 6%. Did that. Here in Phoenix, it just did it almost perfectly. We came down from, in March 22, we dropped down 11.5%. Then we came back up to 6.5%. I think we're forming a second peak now. I'm pretty sure about it. I just need one more data point to be sure, but it sure does look that way to me. And then we come down this other side. So that's what we're looking at. So this is what we're looking at with Charles Hugh Smith. Now, you can see the first peak. You can see the second peak. And I have 3 buys identified. Now, we're investors, so we're putting together pools of capital. If you want to invest with us, you can. This is like me buying properties in your name, but we're going to be getting commitments so we can buy, because I think we're probably 12 to 18 months away from this first buy. What happens on a first buy? It is not as the very bottom, but it's probably one of the best places to buy properties, because that's where you get really, really good trophy properties, really, really good properties that investors were forced to sell because they needed the cash. So this is very, very common, and we like to buy a lot of those properties. Now, remember, I have been out of the market for a really long time. I expect to pay probably 2019 prices for these, 2020. In talking with Charles Hugh Smith, he is, well, let me go see if I've got that on my slide. No, I don't have it. So Charles Hugh Smith thinks that we could go down 30 to 35% pretty easily. I think so too. I think that that's probably baking the cake. Here in Phoenix, probably not going to see as much because we're such an in-migration state, but we're not going to be immune from it. Some of the worst markets that are losing demographics, they're having governance problems and population leaving. They could easily see more than us. The number of 65% was thrown out. Charles Hugh Smith, and I strongly recommend that you look at our video that we just did. Thinks that we could maybe retrace all the way back to 2008 prices. That would be pretty extraordinary. That'd be pretty amazing. It's possible. We have some historic things going on. Historic amount of liquidity. Now it's being drained. When you get this historic amount of liquidity, you get all these extraneous things that they just don't make sense. And those all have to be taken out. All these extremes have to be taken out. And we could easily get that. So let me go to my next slide. We're just going to talk about that. So this is where we're at. I have been forecasting that we are going to see the market really come down. And we just got this from the National Association of Realtors, says that the pending home sales for August were the worst on record. They tied 2020 shutdown. Of course, that was, that's kind of an aberration. This is not an aberration. This is absolute fact. We are seeing a tremendous amount of builder inventory developing. And I've talked to you about that in other videos, is that the builders, they have land. The only path for them to get rid of the land is to build it out. They'll do everything they can to get rid of it, because if they have land in a downturn, it will bankrupt the company. So they want to get rid of it. And what we're seeing is that we had the worst pending home sales in August ever. So this is following our forecast to the T. We're expecting that this is going to be followed. I expect that we're going to complete the cycle. We're going to have a waterfall event. I think it's going to be terrible things. I think we're going to have real problems, and it's just going to lead to opportunity, but lots of pain along the way. They say forest fires clean up the forest and get rid of all the dead wood, but it is a very, very painful process, and it's going to take a couple of years. So what I'd like you to do, if you can, is to reach us. If you're interested in doing this, we're really, really good at it. We're dedicated to it. We're fiduciaries. We take very, very good care of your money as if it's our own. And you're welcome to reach us at this number and schedule a time we can talk. We can schedule a consultation. We do charge for that. It's pretty nominal. It's pretty good. You'll get all our research. We'll talk to you about what we think is good for you, and put you into our pool. And of course, when we buy a property with your money, it's your property. We're just going to help you manage it, and we do some portfolio management for it. So in the meantime, my very, very best to you. Bye-bye now.